Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy podcast, and today we're going to give you some updates on post-election expectations, as well as some concerns about the millennials and Gen Zers about the cost of obtaining a home on a survey that was completed recently. So let's hop into it. So first week after the election, I'm sure a lot of people were surprised by the results in regards to how big of a win it was. And right now the cabinet's being selected. There's a lot of stuff going on. So this past week after the election, we also received a decrease in the rates, right? Fed cut rate. So stock market rallied, looked really good after the election. And again, it's something that's not going to be able to be sustained because there's a lot of other stuff going on out there with Israel, with stuff that's still going on in Ukraine, and there's still some inflationary measures out there that's impacting some stuff. But nonetheless, Trump wins. Thursday, we get a quarter of a point rate cut. Well, mortgage market rates didn't really move much. Actually, they kind of worsened a little bit. And you think anytime we get a Fed rate cut, which we've talked about in the past, right? You get a Fed rate cut, we expect the rates to drop, but typically it's already baked in. So it was already kind of baked in there. We expected the quarter of a point rate cut to come into play, but the issue was with the stock market rally, the concern was the bond market, right? Because remember, mortgage-backed securities are connected to the 10-year Treasury. They kind of follow that yield spread there. The yields on the bond market actually went up as well. So what does that mean? That means people that are wanting to lend money to buy up federal debt or lend the federal government money, okay, want a higher yield because they're concerned about getting paid back or the risk involved. Because anytime you're buying a bond, it's just like anything else. It's like assume like lending money to a risky borrower, right? The riskier the borrower is, the more yield that they want on the back side or the higher interest rate that they're going to get. The concern hanging out there that's been talked about a little bit, and it was part of the debates that occurred during the presidential election season, is Trump and what he's thinking about doing with tariffs, okay? Typically you would think, hey, if I put a tariff on someone, the cost of that good is going to go up, inflationary measure, right? Something that could cause inflation. The whole concept behind it is to make American companies more competitive, right? Again, this is not a political podcast, just a little bit of background on what's happening here. So if we can make more American companies more competitive, creates more job growth, and it will help stabilize those inflationary pressures, actually. So it's a little bit of a risk, a little bit of a gamble, but it should work. We'll see what happens, right? It should be interesting as what's going to happen over the next 6 months or so. So overall, the same outlook on what we anticipate is going to happen next year. We're going to have this slow slide down on the rates, right? It's not going to be dramatic. There's been a lot of talk about the new president-elect removing, well, he's not going to reappoint Jerome Powell as Fed chair, all right? But there's been a lot of talk about kind of removing that piece of this and moving it into the executive branch on dictating rates and what's going on with inflationary measures and using the in-house economists to kind of state what's going on, what's going to happen, and how we should play this. So I'm very interested in keeping a close eye on what's going on. So we'll see. But we still anticipate rates to continue to slowly slide and mortgage rates to slowly follow. So we do expect rates to continue into that downward trend into spring and summer next year. So there's that. Anyways, let's go to the survey. So home buying comes with a hefty price tag, not even including the down payment. Buyers, especially millennials, are caught off guard by the costs associated with purchasing a property, a study found. So these are some numbers from this study. So the average home buyer spends almost $32,000 in home buying expenses, research from the Clever Real Estate shows. Okay? So such expenses, what they're talking about is including repairs and renovations. The average there was right around $13,500. Moving costs, private mortgage insurance, like that's not paid separate, whatever, and closing costs, all right? So the reason I bring this up is because I wanted to talk about closing costs, and I was looking up the average in my state, in the state of Ohio, and the average closing cost expense in the state to close a mortgage loan was $4,223. Now, agents that are watching this will be like, well, you're telling people to get more paid by the seller than that. your closing costs are crazy high then. No, they're talking specifically because when we kind of advise on getting closing costs, we always use the words and prepaid items, right? There's a separation there. The definition of closing costs technically on the lending side is going to be anything lender related, origination, admin, doc prep, underwriting fee, a processing fee. It could be credit reporting bills. The appraisal fee is in there, and the title side. All right, title insurance, you name it, the whole title piece. So that's what they're referring to when they're talking about the closing costs. So the average is $4,200 in the state of Ohio. All right, a $300,000 house, that's probably going to be right in the ballpark, right around $4,000 on the closing cost piece. But everybody's wondering, well, why do I need $6,500 to close that? What's that situation all about? Everybody always forgets about the prepaids side, okay? This is why it's so important that when you're structuring your contract, when you're going to the seller and asking for closing costs to be paid, that you say closing costs and prepaids, or closing costs, points, discount, prepaids. List it all out. That's great. That way they can't fight on saying that, you can't use all the concessions the seller paid because we didn't spell out what it could cover. So anyways, prepaids, things like homeowners insurance, right? We've had multiple podcasts about the cost of insurance and how crazy it's gotten lately, right? You used to be able to get it for $55, $65 a month. Now it's, in the hundreds consistently, even on lower sales price points. So you've got your annual homeowners insurance, and if you're escrowing, you usually have a 2-month cushion. So you got 14 months of homeowners insurance. So, that's going to run you about $1,400, $1,500 by itself. And then you have your property taxes. Now, each county is slightly different on if you get a credit or don't get a credit. Every state's a little bit different in regards to, are they in arrears? Are they being paid ahead? What's happening here? But just for an assumption, assume 6 months of property taxes. You got a property tax bill that's, $300 a month. That's an extra $1,800 tacked on there. So just between homeowners insurance and property taxes, initial escrow deposit, $3,000. I've seen huge escrow accounts, $7,000, $8,000 in the prepaid section. So that's why that expense to actually close the deal is so much higher than what you will be researching in regards to the average closing cost, because those two things are separate. Don't forget that. So I wanted to kind of bring that up. It also doesn't even talk about daily interest. That's an expense to close your deal also. So daily interest, think of it as per diem, right? So let's say you're closing on the 15th of November, right? And in our industry, we just automatically assume a 360-day calendar year. That way every month is an even 30 on this, all right, when we calculate daily interest. That's how we do it. So let's say you close on November 15th. You're also going to have 15 days of daily interest to cover to get you to the next month, right, before your amortization starts on your mortgage. And your first payment is due January 1st. So let's say, I don't know, I don't have the numbers here, so I'm just playing a game. Let's say you have a 7% rate, and you're buying a $200,000 house, and your per diem interest, that means daily interest every day on the mortgage is, $30, for example. So if we're going to collect 15 days at closing, right, that's $450 in additional costs that you have to close that deal. So these are all things that are going to be calculated into your cash to close, and it's all going to be put into the closing cost bucket, even though they're classified separately as prepaids, closing costs, and stuff like that. So if you're doing research, that's why you might see some of this variance, or why your lender may tell you to try to ask for, $6,000 towards closing, $7,000 towards closing, whatever it might be, depending on your situation, whether you're buying down points or what have you. So just a PSA there, guys. I hope that information was helpful. Stay tuned. We're going to continue watching what's going on in the market. It's going to be a little volatile for a little while, and we're going to see how this new administration handles this stuff. And let's hope for a good winter and a great home buying season in the spring. And if you have any questions, you holler at us. All of our information is down here at the bottom. Okay. But remember, subscribe on YouTube. Check us out on Apple Podcasts and Spotify. Check us out on TikTok too. And we will catch you all next week.